Welcome to the Daily Drawdown, where memory inflation, market rotation, and capital costs set the tone. The biggest story right now is simple. AI demand is no longer just lifting chip stocks. It's pushing through to device prices, corporate capex, and inflation expectations. That matters because once hardware costs start moving together, the market stops treating this like a narrow tech story. Apple just raised prices on select Macs and iPads by roughly $100 to $300, with some reports pointing to even larger increases on certain models. What stands out is the reason Apple explicitly tied it to a roughly four-fold jump in memory and storage costs over recent quarters. For a company with Apple's pricing power and margin structure, that tells you this isn't a small component wobble. Analysts still think the move trims gross margins by about 1 to 2%. The practical read-through is bigger than Macs and iPads. This is a live test of how much premium device demand can absorb before any similar pressure reaches iPhones. On the supply side, Micron may have just changed how investors value memory entirely. The company disclosed 14 long-term customer agreements, locking in about $100 billion of minimum contracted revenue, plus around $22 billion in cash receipts, with gross margin floors above roughly 80% into 2029 and 2030. That's why the stock ripped higher, and why the market is shifting from viewing Micron as a cyclical commodity name to treating it more like a structurally scarce supplier. Gross margins moving from about 39% a year ago to the mid-80s is the headline, but the real point is the order book. Capacity is getting spoken for years in advance. This isn't staying inside the semiconductor complex. Analysts are warning DRAM and NAND shortages could last through 2027, driven by AI inference and high bandwidth memory demand in servers, and customers can't easily substitute away from memory. That shortage is already cascading outward. Microsoft raised Xbox prices by roughly $100 to $150. Storage component costs are up about 2.5 times, and some forecasts see more doubling by 2027. So the phrase to watch is a tax on devices, memory, chips, and power are raising the baseline cost of hardware, and that can keep core inflation firmer than a lot of people expected. The deflationary AI story may still happen, but economists and industry people are saying the productivity payoff is likely years away. The inflationary capex and supply squeeze are here now. That lands at an awkward moment for the Fed. Policy is still restrictive. Core PCE is running around 3.4% year over year. Core services inflation remains elevated, and officials are not giving the market a clean path. John Williams still sees inflation trending lower over time, but the near-term mix is messy enough that capital-intensive AI projects have to clear a higher hurdle rate. And even if capital is available, chips are not the only bottleneck. Industry insiders say the real choke points are land, permitting, and shortages of skilled construction and operations labor. That means data centers and fabs can take years longer to absorb new supply than investors assume, which helps keep contracted capacity valuable and pricing elevated even as new projects break ground. One clear market consequence is rotation. Investors are moving away from the most crowded mega-cap AI winners and toward the companies actually building the physical stack. Memory suppliers, industrials, equipment makers, defense, and power-linked infrastructure. The market has been compressing multiples on the biggest platform names, while money follows real spending into names tied to servers, data center equipment, fabs, and industrial build-out. Qualcomm fits that shift. It reiterated a target of about $40 billion in non-handset revenue by 2029, including roughly $15 billion from data center and custom AI chips, with partnerships involving hyperscalers like Microsoft and Meta. Across the sector, SK Hynix broadening U.S. investor access and EMI buying Synaptics for $7 billion, both point to the same thing: repositioning for the next phase of semiconductor demand, not the last one. The risk is that this rotation is happening in a market already running hot on leverage. U.S. options activity is at record levels, around 70 million contracts a day in the first quarter, and retail flows are increasingly concentrated in meme names, single-stock products, and leveraged thematic trades. A big example is money piling into leveraged DRAM exposure while memory headlines are getting hotter. That can amplify upside, but it also makes the unwind sharper if sentiment shifts. Margin debt is also up sharply year over year, with some comparisons starting to look uncomfortably late cycle. If you combine record derivatives activity, concentrated AI positioning, and expensive financing, the setup for a leverage-driven drawdown is real, even if the underlying secular story stays intact. One place clearly losing the capital allocation battle is crypto. US Bitcoin ETFs have seen more than $6 billion of net outflows over the past month, while Bitcoin slid below key technical levels and options markets showed heavy put skew. The message from the tape is straightforward. In a world where investors can chase AI-linked earnings, contracted semiconductor capacity, and defense spending, crypto has struggled to hold attention. Outside tech, energy, and defense still matter because they tie directly into inflation, logistics, and infrastructure. Oil has been swinging on Iran and Strait of Hormuz headlines, but banks like Goldman are still looking for softer prices into next year unless supply tightens harder than expected. The more durable pressure point may be shipping. Tanker scarcity, high insurance costs, and charter rates are all complicating energy flows even without a full supply shock. Meanwhile, defense spending remains firmly bid, with major missile and interceptor awards and a very large Pentagon funding pipeline supporting primes, suppliers, and space-linked contractors. And on power, the U.S. nuclear push is worth watching. New reactor progress and small modular reactor pilots matter because AI's build-out is ultimately constrained by electricity as much as by semiconductors. Two final policy moves stand out. Starting July 1, Medicare coverage for qualifying seniors using GLP-1 obesity drugs opens a much larger market for Eli Lilly and Novo Nordisk, though broader access could eventually pressure pricing power across the category. And the White House move blocking Chinese-owned Polestar from selling its 2027 models in the U.S. adds another layer to trade friction, while potentially reshaping EV competition in favor of domestic producers. The near-term checklist is clear. Whether Apple sees demand resistance after the price hikes, whether Micron's contract model pulls the rest of memory pricing higher, and whether inflation data starts reflecting this hardware pass-through more clearly. After that, watch permitting, power, and labor. If those bottlenecks don't ease, AI stays an infrastructure scarcity story much longer than the market may be pricing. That's the brief for today. You're listening to the Daily Drawdown, and the market right now is rewarding hard assets, hard capacity, and hard cash flow. This episode was generated by Podkey. Create your own at podkey.fm.